The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of November 11th. If you're new here, thanks for joining us. And if you're a regular, don't forget you can throw questions and thoughts into the comments. As always, my goal for this content is to use my economics background to help you better understand the economy and the financial markets so that you can make smart, informed financial decisions. So with that, let's go ahead and hit the books and get up to speed on the markets. Of course, the first big topic from last week has to be the presidential election, where former President Donald Trump scored a resounding victory in both the Electoral College and the popular vote. Along with that, Republicans have taken control of the Senate and will most likely have control of the House as well. This combination, which some are referring to as the red sweep or the Republican sweep, gives both the president and Congress a significant amount of power and influence to implement their campaign promises and their political and economic agendas. Of course, it's important to mention that several aspects of the incoming Republican agenda could lead to an increase in economic growth, could lead to an increase in economic prosperity, but could also lead to an increase in inflation, the national debt, and the deficit. It's also possible that some of these policies end up to be counterproductive and actually reduce economic growth, possibly increasing inflation still, and potentially creating a situation where we observe stagflation. Because we don't know which policies will actually take shape or what the economic implications of those policies may be, it's important to mention that as we make financial decisions and as we study the financial future, we keep in mind that priority should go to the actual changes that have taken place as opposed to proposals or ideas that have been floated. It's important that we be patient and we be vigilant in our observation and take action on the actual changes that occur, not simply on campaign promises or campaign fears. So our research analysts, prior to the election, had presented a theory that if Donald Trump was victorious, we would see an increase in the stock market and a decline in the bond market, otherwise known as a sell-off, leading to higher bond yields. Fortunately, they were correct, and this is exactly what we saw in the days immediately following the election. We saw a significant jump in the stock market on the day after the results were finalized, and we saw a significant sell-off in the bond market, leading to an abnormally large increase in Treasury yields. Some analysts have argued that the excitement in the stock market was a result of the proposed fiscal stimulus of the Trump presidential campaign, including a reduction of the corporate tax rate, continuation of the Tax Cuts and Jobs Act, and an aggressive policy to reduce regulation and oversight. At the same time, analysts believe that the sell-off in the bond market was a result of both expectations of economic growth as well as concerns for the inherent inflation that fiscal stimulus traditionally creates. Assuming that the bond market is correct, the increased stimulus could lead to increased deficits, increased national debt, increased inflation, and ultimately higher interest rates. Of course, as we consider the possibilities, it's again important to mention that at this time, it is most prudent to take action on policies as they're enacted and as they're put in place, not necessarily simply because they were promised during a very competitive, sometimes contentious political campaign. We also saw an increase in the value of the US dollar relative to other currencies. This also matches some of these predictions we've seen in the other markets. Typically, the value of the dollar rises as inflation expectations increase. The value of the dollar rises as interest rate expectations increase. And the value of the dollar could potentially be rising in light of the increased debt and deficits that will need to be funded by government fixed income securities, such as 10-year treasuries. This increase in the value of the dollar on the surface seems promising, but a lot of economists would remind you that increasing the value of the dollar can actually be quite problematic, in part because a more valuable or more expensive dollar can lead to a reduction in exports, meaning American companies struggle to sell their goods and services abroad, and it can also lead to an increase in imports. As the value of the US dollar increases, foreign goods and services become more affordable and more attractive, hence increasing the amount of imports and reducing the amount of exports occurring in our global trade system. As mentioned earlier, all three of the major stock indexes ended up higher last week. The Dow Jones Industrial Average and the S&P 500 both increased between 4 and 5% for the week, and the Nasdaq actually increased closer to 6% for the week. 10-year Treasury yields initially early in the week increased as high as almost 4.5% before falling in the latter half of the week down to about 4.3% at the end of Friday. The last big piece of news from last week was the Federal Reserve deciding at the November meeting of the Federal Open Market Committee to reduce interest rates by 25 basis points. This is following a 50 basis point cut in September, and it's expected that there may be another 25 basis point interest rate cut in December at the final meeting for 2024. This decision by the FOMC was unanimous. All voting members of the board supported the 25 basis point cut. The Federal Reserve, in their press conference, made sure to explicitly mention that the economy is strong, the labor market is solid, and inflation continues to fall on the path towards their 2% goal. The Federal Reserve specifically mentioned that they find themselves in a place where they are now trying to identify the right speed and the right destination for interest rates over the next 14 months. The Federal Reserve's current approach to interest rates is fluid, and one of the important messages that they attempted to convey in their press conference is that should the economy continue to perform in the way it has, and should the fight against inflation continue to trend in the right direction, that they do not see any reason to change their interest rate reduction plans or expectations in the short term. Although, given the change in administration, the change in economic policies that could occur, and the potential resurgence of inflation, they also stand prepared to monitor the data and to change their interest rate cuts, potentially becoming interest rate increases should the battle against inflation begin to trend in the opposite direction. This week, we'll see more earnings reports for the third quarter of 2024 coming out of both S&P 500 and NASDAQ companies. It's important to note that up to this point, we've seen the majority of companies beat expectations on both their earnings per share and their overall revenues. The reflection at this point has been that there was a strong, profitable third quarter for most companies, although as we get closer to the end of full reporting, we'll actually have a much clearer picture on the market as a whole. Some important earnings data for this week is going to be earnings coming from Walt Disney, earnings coming from Chinese tech giant Alibaba, and earnings coming from several different healthcare and biomedical companies. Also coming up later this week, we'll see the reports from the Consumer Price Index and the Producer Price Index, both of which giving us a read on the current state of inflation. We will be watching to see how those prices have changed, whether they've changed consistently with previous trends, and whether we're starting to see any hints of a resurgence in possible inflation across housing, food, and other sectors. Finally, towards the end of the week, we'll see updated data on retail sales, import and export prices, and industrial production, all of which help us to try to craft and get a better understanding of how the economy continues to perform in the fourth quarter, specifically how the economy has performed in the month of October. We'll be watching these reports, and any interesting or valuable information that we see, we will make sure to bring to you in next week's update. Looking to the future, our focus will most likely be split between analyzing the current conditions in the economy and the financial markets and trying to help you get a better understanding of the potential policy changes that could occur over the next 12 to 24 months. Our focus will primarily be on actual policy change as it's implemented, but we also think it's important to talk about what could occur and what the potential implications of those changes might be. Also, coming up in the near future, we should be able to complete and wrap up our summary of the third quarter 2024, which should allow us to reflect and compare the third quarter of 2024 with previous quarters as well as previous years. This will allow us to put in context and put in relation how the economy is currently performing with where we think it will be in the future, as well as where it has been in the past. We'll also start to see over the next few weeks more and more data and information giving us insight into the fourth quarter. And as we move further into the fourth quarter and the end of 2024, we will do our absolute best to bring you that information, share that insight, and help us start to understand what the predictions for 2025 might look like. As with last week, we continue to see the manufacturing sector struggling, most likely still in a period of contraction, although there continues to be optimism about the future and the future potential. And we continue to see the ongoing struggle between the fight against inflation and the potential slowing of the labor market. As we collect new information, as new analysis becomes available, our focus in this reporting will continue to be an understanding of the manufacturing sector and the struggles that they face, as well as the ongoing struggle and trade-off between inflation and unemployment. With that said, we will continue to do our best to watch the economic reports and the changes in the financial markets in order to bring you up-to-date information and keep you up to speed on the markets around you. If you found this video helpful and you'd like to see more, don't forget to like and subscribe to the channel. Also turn on notifications so you know when we've released new content. Don't forget to check out some of the other series that we have, Share the Wealth and Well It Depends, here on the John G. Ullman channel. With that, I want to thank you for joining us, and I want to wish you the best of luck this week. We look forward to seeing you again next week.